Daily Energy Markets live video podcast on Thursday, the 11th of May, with Brent crude around $77. There's been a slight tentative recovery underway this week after three pretty dire weeks. It stayed in a band of around 75, 77 most of this week. We'll discuss why and what the future holds. So let me welcome three familiar faces on the podcast. Dr. Charles Elinas, the CEO of Cyprus Natural Hydrocarbons Company and a senior fellow at the Global Energy Center of the Atlantic Council over there in Cyprus. Dr. Imam Nassery, Managing Director of the Middle East for FGE Dubai here in the UAE, and Jose Chalhoub, Political Risk and Oil Analyst in Venezuela in Caracas in the early hours of the morning. Welcome, all of you. I want to start with Charles Elinas, please. So, Charles, what forces have you seen at work this week to bring about the slight recovery that we've seen? I suppose nothing too bad has happened in the U.S. economy in terms of statistics, apart from the possibility that the country might go bust in a couple of weeks. Everyone is waiting with bated breath to see what OPEC Plus does in its June the 4th ministerial meeting in Vienna. Tell me, how do you see the price curve ahead of that meeting and against the background of possible US default?
Well, what we have seen so far indicates that prices probably will stay low for a while. One of the OPEC countries, Abu Dhabi, already said that they do not expect OPEC to change its production levels at the next meeting, which means nothing much is going to happen. But the expectation is still that towards the end of the year, prices will rise. Goldman Sachs confirmed this week that they expect, or last week, they expect prices to rise to about $95 by the end of the year, and to reach $100 in the first quarter of next year. So the expectation is that prices will still carry on rising once this current phase of uncertainties is over.
And that will be because demand will finally come through from China and other parts of Asia. Is that the reason for the second half rise?
That's the main reason, that demand is going to carry on increasing while production is not going to increase, and the mismatch is going to increase, and as a result, prices will go up. Okay,
but you see that increase in demand from Asia offset to some degree, I know, by factors in Europe, Germany in particular. Please tell us about that.
Well, I mean, Europe is not the biggest user of oil any longer, but Germany has some surprising results that continue to be dire. I mean, in March, the industrial output fell by about 3.4%, but more than that, the German industrial orders fell by 10.7% in March in comparison to February. Huge drop. And the manufacture of cars, of motor vehicles in Germany dropped by 6.5%, the production of machinery by 3.4%, and activity in the construction sector went down by 4.6%. All of these things are pretty dire results, and the trend now is for German companies to base operations in the United States because of the IRA, the Inflation Reduction Act, and the benefits they get out of it, as well as the low energy prices and more incentives. So Germany, and I think Europe is going to have the same problem. It has to reorientate away from relying on industry to other sectors. It's not going to be easy. It will take time. It will be a difficult process to achieve.
Yeah, the German economic model, indeed the European economic model, probably has to be rethought, doesn't it?
In fact, just can I add something? In fact, the CEO of Total, when asked where he plans to build his hydrogen plant. He said it's a no-brainer. It's going to be the United States, not Europe.
Okay.
So it's a trend that is not just affecting Germany. It's going beyond.
Okay. We will talk about hydrogen later. But to stay on the US, Dr. Iman, US recession fears and banking crisis fears come and go, don't they? With the added spice now of a possible damaging debt default in a couple of weeks. But there's a really interesting story on Bloomberg. Late yesterday, it came up. Sheikh Tahnoon Al Nahyan of Abu Dhabi, who controls the Royal Group and other big investing institutions in the UAE, is, we read, shorting US equities, according to Bloomberg, because of recession fears. He's buying short treasuries instead and going into crypto and commodities, Bloomberg says. That's a big call to make against the economy and markets of your old friend and ally, isn't it? But I wonder, you're here in the UAE. Is he right?
Well, Sheikh Tahnoon certainly has some vision and team to look into the markets to make his own call and his firm. But we at FG are also looking at indicators and try to understand whether and if and when and how big a recession is ahead of us or not. And basically our job is to understand that in order to better have a better call on demand for oil. But internally, when we look at indicators, we have yet decided that to exclude such possible, certainly it's possible, depreciation from our base case forecast. And there are good leading indicators that suggest headwinds for economic growth. Certainly the high interest rates will basically put brakes on the economy. The PMIs are not so great for US, Europe, and China. The container throughput and managed money positioning on certain commodities, including the low sulfur gas oil and naphtha cracks, all of them have some messages that tell us that a recession is ahead of us. But when we look at things more closely, for example, starting with interest rates, yes, but they're widely expected to be peaking or nearing their peak, and equity markets have mostly held up in recent months and don't appear to be pricing in a recession. Looking at the PMIs, yes, they're poor, but employment remains high and service PMIs are still healthy. So again, there are these conflicting factors, and looking at container throughput, that is true. It's a weak parameter to look at. The slowing trucks indices also are a concern for many who are following or watching the economies. But most people are comparing year on year, and looking at the last year or two may be misleading because they were quite exceptional in terms of demand for tangible goods coming out of COVID kind of period. And finally, looking at other indicators related to demand for products, we have been convinced that it's not too near or too possible to be included in our base case forecast yet.
Tell me, how big a factor is the possibility of a US debt default in your forecasts? Are you factoring that in?
Well, as I said, it's not yet been considered as big enough to be in our base case. It's certainly in one of our alternative scenarios is the recession, which takes into account that possibility, but that is not something that we're convinced yet to be large enough in terms of possibility to be included as a base case scenario.
Okay. Jose Chalhoub, give us a view from the other hemisphere, if you like, from the other side of the Atlantic about US debt default and the possibility there. There's a very close relationship between Venezuela and the USA, of course. Historically, it's been up and down in recent years. But are there increased economic fears in Venezuela of what might happen because of a US debt default?
Well, thank you, Frank. Thank you very much. Yeah, absolutely. I mean, for Venezuela and for South America in general, I mean, due to the kind of close commercial relationship and the dependence on the dollar of the regional currencies, considering the Bolivar and in the case of Venezuela and the other currencies of the continent. Yeah, absolutely. There's fears about it. That's how you see, for example, problems Argentina is facing with its economy and with its currency, in Colombia as well. I mean, in other countries. I mean, there's absolutely fears in Venezuela specifically, now that we are kind of rediscovering our oil relationship with the US, now that Chevron is ramping up its its stalled its frozen production here in Venezuela up
Yeah,
to
I want
one.
to ask you about that. So these reports came out yesterday. Reuters, I think, reported it, that Chevron wants a big boost to Venezuelan production to get its own debts repaid, mainly. But how big an increase could that be? And where does Venezuela go in terms of total oil production with that kind of boost?
Yeah, that's significant. I mean, since the very restart of this license, the renewal of this license to Chevron, I was kind of skeptical about the quickness of the ability of Chevron to restart and recover or lift up production to now. It's averaging right now 140,000 barrels per day. That's kind of close to how much Chevron was producing back in 2004, 2005, 2006. That's the average of how much Chevron was producing back then.
Out of a total Venezuelan production of what?
Yeah, 150,000, 107. That was back then. Right now, the total production of Venezuela, it's averaging between 600 and 700,000 barrels per day. That's most likely the production right now in Venezuela. Considering all the the difficulties and the kind of the problems in finding the accurate data, because you have the data presented by the Ministry of Petroleum, the data presented by OPEC, and now PDVSA recently presented some data to private investors, including Chevron, that the production for April was averaging 800,000 barrels per day. That's significant. That's some significant numbers. So we have to see the OPEC monthly report that's coming out.
It's later today.
Yeah.
So
it's significant.
On a sort of broader level, is President Maduro becoming friendly towards the USA and big oil again?
It needs to. I mean, that's why I've been saying. I mean, Venezuela shouldn't have broken ties with the U.S. in terms of oil relationship on oil trading. I mean, it has been the most profitable business for Venezuelan oil. We had more than 100 years of oil relationship with the U.S. The U.S. oil companies were present here in Venezuela since the very beginning of our oil industry. So we should have never closed ties with the U.S. So now it's highly convenient for us to retake that relationship.
And pragmatic, I guess, too.
Yeah, pragmatic. Yeah.
Let me stay with you, Jose, on the subject of Russia, which is something that I know you follow. Because it's becoming clear and apparent, I think, that Russia is not making the cuts that it promised back in March, the 500,000 barrels. And I'm wondering how long other OPEC plus countries, especially Saudi Arabia, will put up with this. There was a story on the Digest today that Iraq is 500,000 barrels under its OPEC plus quota. There are special circumstances there, I know, because of the Kurdish pipeline. But it shows that others in OPEC plus are actually making up for Russia's failure to cut. What do we think of that? Will that increase tensions within the OPEC plus group as we come up to June the 4th, the meeting on June the 4th?
Well, this is a personal view that I've always had. I mean, and I think it's kind of, similar to views of other people. I mean, OPEC has always been kind of protecting its own interest, especially, for example, in the case of Russia or Saudi Arabia. I mean, they always protect their own economic interest and economic agendas. So this is why you have constantly this lack of discipline in terms of, abiding by, of their own quotas. So this is why you have Russia in this case, not complying with its, with quotas and cuts, and they're only trying to maximize their share of the pie in the global market. And in this case, Russia, I mean, I consider it. And for example, one case, considering the case of Venezuela, as an example, when we were under tough sanctions by the US, Russia was filling the void, left by Venezuelan oil in the US. When Russia ramped up exports to the US when Moscow was not under sanctions before the start of the war in Ukraine, to 500,000 barrels per day to the US.
Right.
So that void was left by Venezuelan oil. So
Yeah.
you see that you see that kind of opportunistic view of the market,
Charles, on that same kind of theme, we saw Saudi Aramco first profits were down earlier this week, still very big, $32 billion for the first quarter, but down 20% because of falling prices and falling volumes just as significantly, I think. And lower oil revenues were also one of the reasons that the IMF downgraded its GDP outlooks for Saudi Arabia and other Gulf states last week. So my question is: are the Gulf producers feeling the pinch? What can of the cuts policy that they have been pursuing? Are they feeling the pinch? What can they do about it?
Well, they are feeling the pinch, and no question, they rely on prices rising well above $80 before they are reasonably content with their load. But that is going to happen later in the year anyway. So that's why they're not reacting to the current slump. But also you have to remember that
they're counting on a price rise later this year, are they?
That's right. And you have to remember last year was exceptional. Profits that materialized last year are not necessarily going to be repeated again and again. So if we are comparing this high profit, I mean, $32 billion is still a large number.
Absolutely.
And the only reason it looks a bit disappointing is because we are comparing it to an exceptional year last year. If you look at the number itself in comparison to previous years, it's quite a good performance. So I think there is a bit of a overreaction to this reduction in profits because of this comparison to an exceptional year last year.
Okay.
I think profitability will return towards the end of the year. And if Goldman Sachs is right and the prices go towards $100 by the end of the year next year, we will see profitability in Saudi Arabia and petro countries increasing again to reasonably high levels. I don't think the trend is going to change very much. Expectations, even the IEA expects the oil demand to carry on increasing. The IEA now says oil demand by 2024 will exceed 103 million barrels of oil a day. And there is no sign of a peak or a dip or anything like this in oil demand. It seems to be back onto the trends before coronavirus, and it carries on increasing. So if OPEC Plus maintains lower production or controls production, I can see prices staying in that range. I think given that Saudi Arabia's policy is to maintain prices at above $80 if possible, they will achieve that. And that is not a bad level from where to continue to ensure high profits.
Okay. Dr. Iman, give us your take on this broad issue as well. And also, if you can, tell us where Iran is featuring now in this scenario. Production and exports are booming from Iran. So, you know, your overall take on that question.
Yeah, well, I agree with Charles that the OPEC plus and in the driving seat, Saudi Arabia perhaps is waiting. I would not expect any major decision, any major event out of the June meeting of OPEC, waiting for and expecting higher prices in the second half of this year. Starting from third quarter, fundamentals suggest that we should see draws coming, especially in the driving season and peak in demand in third quarter. And maybe they need basically some time, longer than a few days, maybe a few weeks of $70 or less prices to take another action. And also in terms of unwinding the cuts, they would expect at least 1 or 2 quarters of high prices before they decide that basically the supply is too low. So that's my take on OPEC plus, and I think what is most likely happening is that the existing cuts plus the voluntary cuts will continue as it stands until early next year, and that's basically purely based on fundamentals. Obviously, right now and over the past few weeks, it's sentiment that is driving the prices, and the low prices and the falling prices that we've seen is mainly driven by sentiment rather than fundamentals. Now, going to Iran, which is also a factor taken into account in terms of fundamentals by OPEC plus, is that they have been rising their production and exports steadily over the past 6 to 12 months. And right now, they are basically not at all looking like a country under sanctions. If I look at the April numbers, they are producing over 3 million barrels per day of crude, and also some 800 KBD or more of condensate, and product with their 1 million barrels per day or roughly of product exports. Basically, they're exporting over 2.2 million barrels per day of total oil to the market, and that's nothing like zero, which is basically targeted by the US sanctions. Yeah, and we have, based on what's happening, and also they have been gradually and slowly increasing their refining capacity, which would allow them to process more and produce more crude oil and send to market in terms of products. We've increased our forecast for the rest of this year by about 100 KBD out of Iran. And that's, again, something that is taken into account by OPEC Plus in terms of fundamentals and decisions made. And yeah, well, Russia, I agree that Russia's basically non-compliance is also taken into account, but also I believe going to be kind of tolerated by OPEC Plus, given all the politics of members inside the OPEC, and we have seen that in several occasions in the past by some other members. I mean, Iran, when it was a member or a binding member, even UAE had some non-compliance over a certain period, and OPEC has been tolerant because right now their kind of cohesion is more important than these small non-compliance, which in terms of Russia, I think they could justify based on them being on the sanctions or export bans.
Yeah,
so to say.
Okay, right. That's interesting. Coherence is more important than compliance. Sorry, cohesion is more important than compliance. Yeah, that's an interesting way to put it. I want to talk a bit about energy transition and climate change. I was down in Abu Dhabi yesterday at the UAE Climate Technology Summit, the first one that's been held. And today in Rotterdam, the World Hydrogen Summit is taking place with big participation by Gulf countries like Saudi Arabia and the UAE. So as we come up to COP28 in Dubai, just a few months away, climate change, it really is pushing itself to the top of the energy agenda. Down in Abu Dhabi, the theme of the meeting was that technology like carbon capture direct air capture, as well as big developments in clean hydrogen, are necessary to reach climate change goals, on top of the commitments to reduce emissions like greenhouse gases and methane. Now, the environmentalists say that this is just a big distraction from the inevitability of having to drastically reduce hydrocarbon production. The oil people say that it's the only way to ensure economic progress while we get on with energy transition and try for net zero. So if we can call up the survey question, please, which reads like this. Climate technology like carbon capture and clean hydrogen development is the silver bullet that will allow oil companies to meet their energy transition commitments while continuing to produce hydrocarbons. And I would like you just to agree or disagree. Maybe not just oil companies, but oil producing countries too. So I would like you to decide whether the environmentalists are being rather over skeptical of the motives of hydrocarbon producers. So let's do that. So let me ask you, the three of you, broadly about energy transition and COP28. Charles, what about you? Are you expecting meaningful progress from COP28 in the UAE?
I do, but I also expect pragmatism to come out of it. The drive to accelerate energy transition at a time when the technologies required to deliver clean energy are not up to scratch. And for example, last week I was at the Flame LNG and gas conference in Amsterdam, and there was substantial presentations on green hydrogen. The conclusion was that green hydrogen needs a reality check. There is a huge amount of hype, but it's not really delivering, and Europe is unlikely to achieve its targets by 2030. Even the IEA is projecting green hydrogen production to only cover about less of the order of 2% of global energy needs by 2050. So the upshot of the whole thing is that these technologies are not delivering. So shutting down hydrocarbons prematurely while clean energy technologies are not up to scratch, it's not going to work. So there needs to be a balance, a pragmatism. Transition is going to take a long time, longer than expected. And Europe is already paying the price. Europe is moving very fast towards energy transition. There is already backlash within Europe against it. And energy prices in Europe are remaining exorbitantly high in comparison to the United States, for example. So there has to be a pragmatic approach to energy transition at COP28. And I expect the UAE to drive COP28 in that direction.
Okay. Jose, give me a broad overview of how the other side of the world, the southern side of the American continent, sees the whole question of climate change and energy transition, mitigation, etc.
Yes, well, this part of the world in South America, I mean, we have cases like, for example, Chile. Chile has shown important, steps in that direction. But I think in general, the region is far from, from reaching that direction. It's making considerable steps, but countries like Colombia, countries like Brazil, it's energy sources. For example, Brazil has been an extraordinary ethanol producer, for example, or in other sources of energy. But in the case of Venezuela is a very atypical case, because we have been and we will continue to be an oil-dependent country, even though some small steps have been done in terms of trying to diversify our energy sources, but not they're not considerable, but the region has an important opportunity to become a source of other, energy sources, critical minerals like, lithium, like copper, like zinc, like silver, and other, critical commodities. Considering the fact that we are a safer and more stable region than other parts of the world, like for example Africa or the MENA region. But if Latin America doesn't make the correct political moves, now that the region is in its majority ruled by some a new wave of leftist governments, not making the correct not making the correct steps, and nationalizing, for example, the case of Chile, where President Boric took a step to nationalize its lithium industry. Or in the case, for example, in Colombia, the President Petro trying to block new oil production, new oil exploration projects.
Okay, can we pull up the survey result, please? Because we're running towards the end. Can we get the survey result? Right. So wow, we have quite a majority of people who are optimistic in the power of technology to help us meet climate change obligations. I'm quite surprised at that. Dr. Iman, let's go to you for a final word, please. Does that result surprise you? Can we solve the climate change conundrum within the context of hydrocarbon production?
No, it didn't surprise me. In fact, I feel like that's the path that will be more centric to the climate change conversation. We were purely focusing on no fossil fuel for the last, let's say, 5 or more years, since the reheated discussion of climate change took center. But I feel like at least over the past year or so, and especially COP28 and ADNOC's kind of chairing this, will be the point where the change in angle will go from avoiding and excluding fossil fuels into looking at what technologies can zero out emissions, and basically looking at mitigation of that. So no, I feel like the strong voice that we heard yesterday from the Dr. Sultan Jaber yesterday was also the same thing, that let's stop talking about no fossil fuels because we need energy, but let's see how we can make things clean and zero out the emissions.
Well, it's going to be a fascinating few months. Yeah, Charles. Yeah, briefly.
I leave us on a more optimistic note. In the United States, Microsoft has signed a power purchase agreement for purchasing about 50 megawatts fusion electricity produced by nuclear fusion in 2028. That shows that there are now expectations that nuclear fusion is actually going to be commercially available as early as 2028. That's a huge development.
Because it was decades away, wasn't it?
Yes, now it's much earlier, 2028. If they signed it, it means that there is really good hope that this contract will be actually fulfilled in 2028. Okay. Opening up massive opportunities globally for clean energy.
Okay, well, there we go. It's a multifaceted question, isn't it? And it will be fascinating to see how it plays out in the months running up to the COP at the end of November, beginning December. But we've reached the end, I'm afraid, today. That was a really interesting discussion, the three of you. Thank you, Charles Elinas. Thank you, Iman Nasseri, and thank you over there in Caracas. You can go back to bed now. Jose Chalhoub, thank you very much indeed, and see you again soon, I hope.
Thank you.
Thank you. Bye.
Thank you. Thank you.
Bye. Bye.